Welcome back, everybody, to another episode of From the Trenches. Glad that you have joined us again here this week. I'm really excited to have another awesome guest and actually a client of mine as a guest on today's podcast, Shaun Jones. He is a financial advisor, and so I'm really excited to hear what he has to share with us today. But just to kind of give you a little bit of a background on Shaun, he is the contributing author to the book Real Life Financial Planning for Physicians. And he's conducted research in the field of personal wealth management and contributes to articles from major financial outlets like CNBC Online. As the son of an engineer, Shaun picked up the need and value for numbers at a young age and has enjoyed running his own calculations to disprove widely accepted concepts. He's nurtured that desire throughout his career, and he's used it to conduct his own research related to viewing taxation as an investment expense ratio. Shaun even obtained several copyrights related to his research, including the life cycle of taxation and asset location strategy B. After his first 5 years in the industry, Shaun became frustrated with the tools available to financial advisors because they were too simplified and usually biased towards whatever product that they were built to measure. It was then that he fell back on his love of all things mathematical, making his own calculators and hiring actuaries to help build his own tools so he could produce unbiased comparisons. Armed with these tools, Shaun began to test the theories and assumptions that he had been taught to take for granted early in his career, and the results led Shaun to recognize the faults of the investment and advising industry and to dedicate his life to proclaiming the truth about investing. And he's written about a lot of that in his book, Unbrainwashed Investing, which I'm sure that we'll be talking about here in just a few minutes. But Shaun, it's great to have you here on today's podcast.
All right. Thanks, Scott. Thanks for having me. I didn't exactly know how you're going to use that bio. I just copy and pasted the one off the back of my book. So thanks for catch your breath now.
That works well. I mean, for my bio, it typically uses pretty much the same thing that's in my book as well. So,
Yeah.
yeah, I want to kind of pick your brain here a little bit from my audience and myself, because there's a lot of talk right now with all of kind of the fluctuations and everything in the economy and just kind of like what's actually going on, with the stock market, with bonds, with crypto, and all of that type of thing. And as small business owners, I have a feeling that many of us may not really give a lot of thought to, what we should be doing with maybe the profits that we earn in our business. And so I'd love to hear your thoughts, on, if business owners have excess money. Obviously, we're all looking for how can we not give too much of that to Uncle Sam, right? And investing could potentially be a good strategy for that. But we'd love to kind of hear your thoughts there.
So that's a super broad question. I think where I would start with that is everyone wants to get a tax deduction, and even the certified public accounting industry, I think acts as if a tax deduction is the absolute biggest thing to chase. I think something to keep in mind is that we don't make these decisions in a vacuum. And so taking tax deductions, I give you an example. I didn't take tax deductions for the first 3 years of starting this business because I knew that my effective tax rate was going to be pretty low given the startup costs and the money that I was plowing back into the business. And so I was going to have more deductions than normal. And so I didn't take a deduction. I put everything in a Roth 401k.
Okay.
And that's something that you need to consider. So I would guess my first piece of advice is don't chase the tax return, have some sort of understanding of if you should be taking a deduction or putting that into, something like a Roth, or even not taking a deduction at all and investing it in some sort of tax efficient investment. And so, that's all, a lot of that's all going to depend on how many employees you have and what your options are there. But so that's the first thing, is don't necessarily chase the deductions. The second thing is, if you're going to take money out of your business and not put it back into the business, that means that you have determined that you're going to get a better rate of return outside the business and inside your business, or you can't quite figure out how to reinvest that in your business. And so it's kind of a more sure thing to reinvest it outside your business. And so if you're going to take the money out of your business, I would recommend something in the neighborhood of 50 to 70% in a diversified stock portfolio. And I don't believe in getting too cute with that. And then with the other 30 to 50%, find things that are going to outpace the stock market. So if we're going to say the stock market is going to get 8 to 9% per year on average, um, you know, there are ways to achieve a better return, better cash flow, and better tax ramifications, albeit with somewhat less liquid investments in things like real estate funds. You know, there's a natural gas fund that I like. There's a whole bunch, the whole host of those things. But
Mm-hmm.
the overall point I would make is that I wouldn't really put too much into bonds. I don't believe in bonds. I don't know any other financial advisors that buy bonds. And I
Mm-hmm.
think that's a pretty good, that's probably a pretty good, I guess, testament to the fact that bonds are not worth buying for the most part.
Right. So
But
you made an interesting, statement there, of, reinvesting in your business and having maybe, where that maybe could be kind of uncertain, like what's that return actually going to be
right.
versus like, okay, I could go invest in the stock market or I could go invest in, real estate or whatever, asset that it is. And there may be more surety there, so to speak. It's like I can expect to get this rate of return. What kind of helps you decide, like, should I reinvest in my business and maybe, in a sense, take a little bit more risk? And how can that risk be mitigated?
Right. I mean, I think as business owners, if we knew that every dollar we spent on building revenue was going to achieve a certain rate of return, then there would be no end to the amount of debt we would take to do that. Right. And
Hmm.
all you're doing is knowing the rate of return in the business versus what the debt costs. And
Right.
so that's, first of all, if you can add a dollar of revenue, do you know what the return on that revenue is in terms of either, well, the profit to you, the dollars and cents after your expenses, or in my business, it's about the value of the firm itself. So, and I think that depends on, is your business one where you will have a saleable asset at the end, or are you just trying to reinvest for greater revenue down the road?
Hmm.
So that's an individual formula that you have to come up with. Thankfully, in my business, that's kind of a known formula. So for me, it's just, can I add revenue? The return on that revenue is really high. That's not really the question. The question is, how do I generate that revenue? Do I give it to Scott and he, you know, gets me dollar for dollar on the marketing? Do I somehow invest in something that's going to reduce my expenses to bring my EBITDA up? I mean, there's all different ways to do it. So one is knowing what the return is. Two is figuring out how to achieve it.
Hmm.
Um, and I don't remember exactly what your question was around that subject, but
Yeah.
I can talk about my own business, but I'm not sure how useful or not that is
Yeah.
for.
Is there a way, because I know like when we were kind of talking before we, started the recording, is there, you said you've kind of figured this out for your business. Like, if
Yes.
I invest, reinvest the money in my business, I know that it's going to do probably better than what I can get, investing in stocks, or some other asset. Is there a kind of like a starter formula that small business owners can kind of like use to kind of like help them get started on that path? Because I'm sure it's probably going to be a little bit different for each business.
Yeah. I mean, what I did, fortunately, in this industry, the volume of acquisitions is high. And so there's kind of anytime you have high volume in a certain asset class, the price for that asset is much more well known, right?
Hmm.
Um, and then it's more formulaic. Um, so the way that I became to understand that what the formula was in my industry was I spoke to a couple brokers, people that buy and sell or help clients buy and sell businesses like mine. And so I
Hmm.
think that's probably good. That's probably a good place to start no matter what. Even if you just have a startup, even early on in my business, I didn't know what that was, and it became difficult to make decisions on what to invest in and how to spend money. So for
Hmm.
me, I wanted to talk to a broker and understand, okay, will someone else come into my business and value it? And
Hmm.
once I know that formula, then I know how to manage the value of my firm.
Okay.
Um, and so try to distill it to a formula and understand what the levers are, and that way you can understand what to invest in. If in my business, it's really past a certain level, it's just based on gross revenue. And so
Hmm.
that tells me reinvesting in my business, I don't have to worry about what I spend to get the revenue
Yeah.
as long as I get revenue. It doesn't matter. But in
Hmm.
some businesses, it might just be profitability. So anyway, I would encourage early on for business owners to understand as closely as possible what that formula is like in their industry, and then that will help them determine, what if it's worth pulling it out or not. I know of industries that are the business is unsaleable. So
Hmm.
you basically just you run it on profit, net profit only, right? You
Yeah.
don't spend anything to create revenue unless it's going to be profitable revenue.
Hmm.
Because if you can't sell it, that's the only value is the profit.
Yeah.
So anyway, I don't know how you get if you don't have a desirable business yet because it's not big enough. I guess you just would go and buy a broker dinner or buy them beers and try to help them through that or whatever. I don't know how you get the information in that case, but
Yeah.
uh, get it however you can. That's what I would say.
And I know that, I've had conversations, in other groups where people, especially if you're starting out your business, it's like, be thinking of the end in mind. Do you eventually want to sell it? You may not be in a position where you can, just yet, like you said, but, thinking of that end goal and then getting the information and kind of working towards that, I think is really powerful.
Yeah, for sure. And I put that off because I know I don't want to sell anytime soon. I actually can't imagine selling ever in a way where I step back from the role of having direct contact with my clients. Like I cannot
Hmm.
imagine letting someone else take care of my clients. I just feel that responsibility. And I'm sure there's a lot of people out there with that same exact hang up. So for me, it's like, why would I talk about a sale when I can't imagine ever selling?
Yeah.
However, there are different versions of that where you sell the business and stay on as, in my case, I would stay on as my advisor to my clients.
Hmm.
And there's different motivations behind all that. In some cases, that could be better for my clients if I have more resources from another firm. So I kind of just was like, I don't think I ever want to sell, but let's just say in 5 years, who knows? Life happens. Let's just say I have to sell.
Hmm.
Something happens in my life where I have to sell.
Yeah.
And I get to that point, but I haven't managed towards a sale and I have to sell. I can't sell it.
Yeah.
But if I get to the point and manage it towards a sale and I don't want to sell, fine. I have a saleable asset that I don't want to sell. I'm just going to let it keep appreciating. So for me, it was just managing towards a sale, even though I don't ever want to sell, just because I don't want to be growing a dead asset. That's kind of like, and I think that's where everyone should get to the point where you can sell your business. And it's amazing how much clarity that will give you on how to run your business.
Yeah. And that's something that I look back on, with my first business, IT company. I finally was like, I'm ready to sell this, but I hadn't really been working, towards that. Had I been working towards that, for the years prior, probably would have, had a totally different outcome, for selling that.
Yeah.
So definitely worth considering. I'd like to, shift gears a little bit because, your book and what I read in your bio there is that you kind of go back to your bio is that um, the faults of the investment and advising industry, and you're dedicating your life to proclaiming the truths about investing. And that was really kind of the motivation of you writing Unbrainwashed Investing. What's kind of, without giving away all the secrets, obviously, in the book, what's kind of like the premise or, kind of the motivation of, revealing kind of the unknowns that most of us aren't aware of in that space.
Right. So at this point, it's indeterminable to me on my original motivations for writing the book versus what is most potent for me now in the book. So I'll tell you about that aspect of it, I guess. The motivation for writing the book is I was just frustrated in general. And most of those frustrations were because I saw the changes that I thought needed to be made in my practice on behalf of my clients. And I was unable to make them at my previous firm.
Mm-hmm.
And so in that environment, I was someone that I knew there was something better I could do for clients, but I literally couldn't do it. And I think the
Mm-hmm.
industry is filled with that. So there's two scenarios. One is the scenario I was in, something I think would be better for my clients, but I just can't do it because of what limitations my firm has. And those limitations exist because of basically lawsuits and fines.
Mm-hmm.
They are so afraid of lawsuits and so afraid of fines that they throw a blanket over their 2,000 advisors and say, you cannot do this, you cannot do that. Um, and you can't even have conversations about this. And it's essentially because they don't trust advisors to be a good steward of the truth.
Mm-hmm.
Whereas fast forward to today, I'm not worried about I'm not at all worried about getting sued. In fact, I record every single conversation I have because I tell clients everything about the risks that there are to investments. And in my mind, if I tell you the risks and I tell you the rewards and I tell them honestly enough to record them so that other people can hear what I told you, then you have a good bit of information. You have the right amount of information and in the right proportion to make a decision. And
Mm-hmm.
I think that's but the opportunity for me to do that and record everything and monitor my own risk was not there. And so with the way that they monitor that risk was just say, no, you can't talk about that. We don't want you to do that sort of product. We don't want you to talk about this sort of real estate or whatever it is, whatever the product is.
Mm-hmm.
Um, and so that's that was one of the big frustrations. So what I see in general now is there's the overreaching way that advisors become successful in the industry is it's a very difficult industry to start in. It's a very difficult industry to build your practice in. It has an 85% failure ratio in the first 3 years.
Wow.
And it's still like 50 after 5 years. I mean, it grinds people down. And the way that you succeed is not by being a good advisor. It's not a build it and they will come scenario. The hardest thing to do in any business is find clients.
Right.
And so you could be the best financial advisor with the most knowledge in the world. If you can't find clients, you are never going to have a financial advisory practice. It's not going to
Yeah.
happen. So the people that have built successful financial advisory practices are those that are either good at selling, um, well, it's really just that. You have to be good at selling. And
Right.
I'm not saying they're selling products that don't work,
Mm-hmm.
but sales is just finding enough clients to tell your story to. And if you're telling a good story, an honest story, and it's the story that is absolute best for every client, and you can also find the most clients, then you have a good practice. But
Mm-hmm.
what actually happens is when you're 6 months in the business and you don't know anything about financial planning or any taxes or any of that, and I was a finance major in college, that doesn't mean anything. Um, then what you can rely on is what you're told.
Mm-hmm.
And what you're told most of the time by these large firms is they don't have huge training programs that what they do have though is they have unlimited investment firms, that is firms that have an investment to sell, whether it's annuity or a mutual fund or whatever. Those firms have huge budgets to send people into your office and I won't call it train, but to have discussions around certain scenarios in investing and how their product um, will satisfy the risk reward in that scenario. And so what you end up with is basically the way new advisors are trained is they're never trained without some sort of investment vehicle
Hmm.
behind the scenes. So there's always motivation in the training they get.
Uh-huh.
And the reality is, I think everyone's figured it out, is that data is, very subject to manipulation. Research is very subject to manipulation. And this industry is the first industry where I realized that basically whatever story was being told, whatever the hero was in the research, that's who paid for the research. And that's how the industry is trained.
Hmm.
And so there's some point in an advisor's life where they have to say, okay, I'm just going to start asking. When that guy comes in to train me, I'm going to ask him the hard questions. Why did you choose those dates for the data you're showing us? Show me another date? Well, we can't. That's not approved. Okay. Well, you've shown me one scenario where this works. And I'm
Yeah.
now, and most advisors, so those are the frustrations I have. And on the client side of it, what I know is I actually just recorded uh, a podcast with just me kind of ranting the other day. Um, and there's the concept I talk about in my book of an uh, honestly ignorant advisor. And I think there's a lot of people that think in the end what clients or what investors are afraid of when they hire an advisor is this person going to um, purposely give me recommendations just for making a commission? Are they going to steal my money? Which, by the way, is if you do, if you pick an advisor with at least two things present, you probably have a 1 in 1 million chance of them stealing money. It's impossible if you find an advisor that doesn't print their own statements. They're not going to steal your money. It's
Hmm.
impossible. Someone else printing their statements, they can't steal your money. It's just not possible. So Bernie Madoff, all the people that have stolen these huge and committed these huge crimes, they are printing their own statements. Find
Yeah.
an advisor that's not doing that, you're not going to get money stolen. So that's really not a thing, but that's what people are scared of.
Sure.
So what they're looking for is someone they know they can trust,
Hmm.
and they're looking for someone that they like. Ideally, someone that's been in the business a while, because then they figure, okay, they've got a lot of experience. And that's how people pick financial advisors, because they don't know any other way, right?
Hmm.
It's the person's honest and I like them and they've been in an industry a long time. And they have a nice house,
Yeah.
right? And they were part of a
So they're
nice,
doing well with their investments. That's going to translate into, mine doing well, right?
right? Exactly. And that's a good point, because one of my main things that I tell people to do is ask your financial advisor if they are investing in the exact same things that they are recommending you invest in. If the answer is no, I don't know what's happening there, because the way that they got that nice house is because of the way they're investing.
Yeah.
And if they're investing your money in a different way, it's not going to translate. Um, so that's a big thing for me and my firm is I don't invest in anything my clients can invest in. And I do not recommend anything to my clients that I'm not already investing in.
Hmm.
And so I think that's the way it has to be. Why would I have some different version of what is a good investment for my own money than I do for my clients? It's either a good investment or it's not.
Right.
Um, and my tolerance for risk is zero. I don't want there to be any chance of losing my money. That's
Sure.
that's my tolerance for risk, and that's everyone's tolerance for risk. What are we talking about?
Yeah.
Um, so anyway, that's those are some of the frustrations, and the biggest one I'm trying to figure out for people is how to help the people that have a friend or even a good friend that maybe they weren't even friends when they became advisor client relationship. They entered into this advisor client relationship, but after a certain amount of time the client is wondering, man, I really like this person, but I don't know if I'm getting the advice I'm supposed to be getting for what I'm paying them. But I
Mm.
don't want to tell them that. I don't know how to say that.
Yeah.
But in my mind, that's like 90% I've seen it. I've been in the industry almost 25 years. I have friends in the industry. 90% of advisors are in the category of honestly ignorant. They are
Mm.
still operating on all the things that they were told and are still being told by these investment companies that come in and buy them coffee and lunch and pay for their wine tastings for their client events. That's where they're getting their research. If
Hmm.
they're spending 90% of their time on the phone with you, they are not doing their own research. They are reading the research they are given.
Yeah.
and not second guessing it, by the way, and not trying to prove that research wrong or doing any sort of academic activities that way. That's not what's happening in the industry. So anyway, those are my frustrations. That's basically what the book is about. And then I was not planning on starting my own firm when I wrote that book. But 3 years later, I did build my own firm based on avoiding the frustrations that are in that book. I literally built my firm around all those frustrations.
Yeah. And so,
Um,
and I'm assuming in the book that like you give the things, here's what to look for in choosing, an advisor that's actually going to work for you, and do the right things as opposed to just being spoon-fed what the industry is telling them to say.
yes. So chapter 11 is what do financial advisors actually do? Chapter 12 is should you work with a financial advisor? 13 is honest advisors give bad recommendations, and that's related to what I just told you about. Chapter 14 is why you should hire just one financial advisor. How do I find a competent advisor? And so it's kind of it's, you know, it is a pamphlet basically on how not to end up with or basically how to figure out if you have an honestly ignorant advisor. And if you don't have one now, how to avoid hiring an honestly ignorant advisor.
Yeah. Hey, when it comes to our money, our finances, that's something, I mean, obviously that's people hold that dear, close to them. And, we want honest advice. And I think there are several industries, at least in my experience, where, there are people that you just absolutely want to trust. I mean, investments, it's not a simple thing to really understand. Then you throw in being a business owner on top of that. There's all, the tax ramifications and the tax filings and all of that. And you start, putting all of this stuff together. And then, you need to have a knowledgeable advisor. You need to have a knowledgeable lawyer. You need to have a knowledgeable CPA. And you need to be able to trust all of these different people. And I think, we've kind of gotten as a society, unfortunately, where we've been burned so many times, um, that we don't know who we can trust. I
Yeah.
mean, even in the medical field. I mean, you were describing, that you have the different firms, investment firms and stuff, whining and dining doctor or investment advisors and stuff like that. The same thing happens in the medical field. I was an executive assistant for a psychiatrist. I mean, literally almost every single day we had lunch provided to us from really nice restaurants from
Yeah.
the pharmaceutical reps, and so those are things that I feel like we do have to be aware of, and then having somebody like you in your book kind of guiding us through how do we navigate that, how do we with that stuff that's actually going on, how do we find the people that really do have our best interest in mind and that do know the industry well enough on their own that they're not just spitting out the stuff that they're told to spit out.
Yes. And without guidance from someone in the industry that has, that's the reason I picked the name Unbrainwashed, is that it's work to become unbrainwashed. And it doesn't mean you know everything, but it does mean you have a process to avoid that part of the industry.
Yeah.
And it's important because God, I mean, 99.9% of all advisors I've ever met in the industry are honest people. They're
Hmm.
not, they're making, they are operating on their truth,
Yeah.
you know, which is not the same as operating on the truth.
Hmm.
Um, but so I don't fault them. They're not bad people, and it's not, the issue is not honesty.
Hmm.
And from a investor standpoint, if you don't have instructions on how to figure out who is operating on their truth versus who is operating on the truth, then how are you going to pick? You have no way to
Right.
pick. So it's kind of like you're kind of stuck with it. And I've actually had the same experience with my primary care physician as well, um, which I'm sure a lot of people have had that experience. But anyway, so I've had this experience in other industries, but it's difficult in the financial industry because you're not giving your doctor your money to hold. You can fire your doctor at any time, right?
Right.
You're not paying them unless you go to see them.
Yeah.
Um, and so financial advisors are pretty hard to fire, I guess, and it's awkward. You can just ghost your doctor. You can't, it's hard to ghost your financial advisor,
Right.
especially if you become friends with them.
Yeah. Yeah, exactly. So, well, as we wrap up, here, just kind of, just going to throw this oddball question at you. There's a lot of talk, at least in the circles that I'm in, where people are talking about cryptos. What's your take on cryptos? Is that too risky for you? I mean, for your perspective, is that too risky for your liking, or?
Yes, it is. Um, and I think it goes to what is the goal? Um, is the goal to double your money over 10 years? If that sounds like really good to you, then you only need to find a 7.2% rate of return. You don't need to invest in crypto for that.
Mhm.
Um, if you invest in something that is expected to earn you 15% per year, which there's plenty of funds out there that I invest in and I expect to. Again, if I'm not investing in the stock market, that's kind of my hurdle there is 15%. And
Mhm.
maybe I'll get it wrong. Maybe it'll only be 12%, but that means you're doubling your money every 5 to 7 years,
Okay.
and that's good enough. But the idea that I could invest in this thing in 7 years, maybe I'll have less, maybe it'll be worth 10 times more. You
Mhm.
can't build a strategy off of that. And I guess if you had no other prayer of retiring except to get, you know, except to invest in something that's going to give you 10 times the money over the next 10 years, then you have to hang your hat on that. But for me, getting 15% and doubling my money every 5 to 7 years, that's good enough for me.
Yeah.
Um, and I don't want to take the chance that I waste money on something else that might not work. I know this plan will work.
Right.
That plan, who knows what's going to happen with that plan? So that's why I don't invest in it. I don't understand it. I don't have an opinion on it. Um, it's just not tried and true, and I can meet my goals without taking that chance. I can use a plan that I know is going to work, and I
Yeah.
don't know that crypto will work. That's the bottom line.
Yep. Gotcha. Awesome.
So, yeah.
Well, as we wrap up here, any final thoughts that you want to share with our listeners? And
No, I would say that as business owners, definitely try to figure out what your hurdle rate is for reinvesting back in the business. Figure out what drives your business's value. Once you're investing outside your business, get help. It's kind of hard at first if you're just starting out, but there are resources, and if there's resources on my website of how to avoid bad advisors, and they're generic, right? So you can take that blueprint and you can use it to find someone in your own area. Um, it's not just about pointing people towards me. It's just about giving people the resources to find a good advisor.
absolutely. And so we'll have links to those resources in the show notes. So definitely check those out. But you can get a copy of Shaun's book at unbrainwashedinvesting.com. And then you can check out his website at jonesfiduciary.com. And like I said, we'll have those in the show notes. Shaun, really appreciate you being here today, sharing your knowledge and expertise on a very important area that I feel that small business owners need to really consider as they're planning their business strategy going forward. So thank you for your time, and we'll see everybody on the next episode next week.